Okay, so we've moved on to some problems from Chapter 10, and they're not. None of these last problems from Chapter 10 are particularly difficult computationally. What I wanted to do, though, was just to give you a sense of what's involved in coming up with the incremental cash flows. And so one of the issues that we need to take into consideration is the fact that for a company, if they introduce a new product, they might erode the sales of their existing product line. That's also called cannibalism. In marketing, you might see that term. And so, we just need to, if we're looking at this simple little example of a bike manufacturer who currently is selling 35,000 units of this bike, this standard bike, for $120, and their variable costs. By the way, this is very similar to some of the stuff that we do in managerial accounting, right? We look at the basically the contribution, so they're selling 35,000 bikes at $120. Their variable costs are $40, right? And then if they're going to sell this new bike, they've got 17,000 expected sales with a price of $410 and variable costs of $300. And if they introduce the new bike, they're going to lose 8,500 of these 35,000 original units. Get rid of those decimals. So the question is, the first thing that they have you do is figure out what they call the erosion cost, which is your price minus variable cost times the lost sales in units. All right, so let's just quickly figure those out. So it's price minus variable cost, or minus production and shipping costs, as they're calling it here, times the lost sales. All right, so our erosion cost here is $680,000. So let's just go ahead and fill that one in. Okay, that's easy. Now, should we start producing the bike? And so in order to come to that conclusion, right, what you have to do is first look at what would happen if they didn't produce the new bike, right? So that's going to be 35,000 times that price minus variable cost. So this is their cash flow without the new bike, 2.8 million. Now the next thing you want to do is look at the net annual cash flow with the new bike, right, which is going to be the new bike sales. And obviously there's a lot of different ways that you can kind of set this up and think about it, right? As a matter of fact, I don't even know if the way that I'm setting it up and think about it is the way that they tell you to in the book. This is just how I think, because I see everything in columns and rows. But it's just a logical process, right? So we look at with the new bike, we have the new bike sales times the price minus the variable cost, plus the, let's see, how should we do this? Let's do just a simple, the eroded sales, right? So it's going to be the current sales minus the loss in sales. So that's going to be our total sales level for the new configuration times, then give that a parenthesis, price minus variable cost. All right, so that should give us something good. Okay, so without the new bike, they've got 2.8 million. With the new bike, they've got 3.99 million in cash flow. So, yes, because it contributes an additional 1.19 million in cash flow. So that's correct. And there it is. Okay, this next one is worded a little weirdly. And you don't need to do any calculations for it. Okay, but let's just read it through. Revolution Records will build a new recording studio on a vacant lot next to the operations center. The land was purchased 5 years ago for $450,000. Today, the value of the land has appreciated to $770,000. Revolution Records did not consider the value of the land in its NPV calculations for the studio project because it had already spent the money. Okay, the net present value of the recording studio is $600,000. Should they consider the land as part of the cash flow of the recording studio? And if so, then what value should be used, 450 or 770? And the answer to that is yes, you should consider the money that you leave on the table or your foregone cash flow when you are looking at net present value calculations, right? Because they could go ahead and sell that land. And I emphasize this and the idea of opportunity cost because if you think about your investment in your education, for instance, right? The investment in your education is not just the money that you spend on tuition and room and board. It's also the money that you're not earning while you're in school full time. And that becomes a bigger deal, right, if you ever consider going to graduate school, because, you know, the money that you forego by going off, for instance, to get an MBA for full time for 2 years of your life, that's you know, not insignificant if you're 28 years old and earning a reasonable living. You know, so when you're thinking about your own opportunity costs in life, you should be thinking about these things. So should they have considered the land as part of the cash flow of the recording studio? Absolutely. Yes. And what value should be used? What should be used is that 770, because that's today's value. That's what they could sell that recording studio for. And in that case, right, if they've got a net present value for this recording studio of $600,000, or they could just turn around and sell that land for $70 and walk away from it, right? Then, you know, how will it affect it? That's sort of the second answer here, right? So they shouldn't, they're based solely on net present value relative to opportunity cost. They should not take on that project. Okay, this next problem, we are looking at working capital, changes in working capital as they affect cash flow. And this also kind of goes back to some of the stuff that we did in managerial, because this is sort of looking at your budgeted inventory needs, right? And so what am I going to do first? I am going to turn this around so that it's horizontal. So here is a little Excel trick that I want to show you. You say copy, right? And then you can say paste special, and you can transpose. And now I've got this whole thing laid out in a way that I like to see it. Okay. So this is the monthly sales, right? So these are not supposed to be in dollars. So let's go ahead and get those in the right format, right? So this is the sales level. Look at our beginning inventory is going to be 10% of the month's projected sales. So we can go ahead and copy that across. And then our ending inventory is going to be 10% of next month's projected sales. Okay, and notice we don't have any data for May, so we can't get an answer to the ending inventory in April. That's okay. And then we calculate the change in inventory as the ending minus the beginning inventory, right? So it's okay. And so we can just go ahead and calculate that out. Right, so we have 10,000 fewer bottles on hand at the end of January than we did at the beginning of January. We have 70,000 more bottles in hand at the end of February than we did at the beginning. And so then our change in working capital tied up in inventory, right? We've got 10,000 items less tied up in inventory. So our change in working capital that's tied up is going to be this negative 10 times 6/10 of a penny. And we'll make that a absolute cell reference for B there. Okay, so our change in working capital in January is a $60 reduction. And then we can just go ahead and copy this out. We've got $420 more in working capital tied up in our inventory in February. And in March, we've got $120 more than we began with tied up in our inventory. And there it is. Okay, and this last one is the only one that's a little bit complicated, and this kind of takes you back again to some of those, some of that work that we did way in the beginning of the course when we're looking at trying to figure out operating cash flow. And so we have got a company that is selling a new GPS system. They're expecting 40,000 units to sell at $21 a unit with production costs at 37% of sales price. Fixed costs are $160,000 and depreciation expense of $180,000 a year, and they pay taxes at 35%. Right, so what is the operating cash flow? So here's how I suggest that you figure out these kinds of questions. I suggest that you do this by basically building a income statement line by line by line and then adding back depreciation. Okay, and you'll see what I mean in a minute. I'm going to pause the recording and do my data entry, and then you'll see what I'm doing. Okay, so I've got this thing set up for you now, just a little simple kind of an income statement, I guess. Shh, don't tell the financial accounting people about this. All right, so this is a cheater income statement that we are going to add depreciation back at the end to get the operating cash flow. Okay, so we've got revenues, which is 40,000 units times $21 a unit. $840,000. Production costs at 37%, so we can just apply our 37% to the revenue to come up with cost of goods sold. Okay, we've got fixed costs of $160,000, and depreciation is $190,000. It's convenient that they give you the numbers in the right order. All right, so that gives us our earnings before interest and taxes. Okay. So our earnings before interest and taxes is $179,200. Our tax rate is 35%. Right, so that gives us a net income then of 179 minus 62,720. And then what we have to do is add back our depreciation expense, because remember, depreciation is not a cash expense. So we add that back in. And that gives us our operating cash flow. Okay, so it's 306,480, I hope. And there it is. Okay, so again, these relatively straightforward problems from chapter 10 were just to kind of get you thinking about what it takes to actually figure out what all those cash flows are. Okay, because you know, when you have Excel to do your return calculations and your net present value calculations, doing a capital budgeting exercise is not really all that complicated. The hard part in capital budgeting is figuring out what the cash flows actually are. Okay, so that's why we did this, and have fun with your own graded homework for this.